Hi, guys, and welcome back to Hello Adulting, the podcast. I'm Shanique. Now, this is Hello Adulting, the podcast archives, the archival episode. Now, Hello Adulting, the podcast is not new. We have over 50 episodes that have been published over the course of 2020, 2021. And there were a lot of nuggets, a lot of good information that has been shared. Now, as you know, that this Hello Adulting space is a space where we go through things that nobody taught us in school, things that we really should know to really tackle this adulting space in the best way possible, to put our best foot forward, to live meaningful adult lives. Things like money management, things like HR matters, things like how to maneuver the corporate space, and so much more. And we've covered a lot of that over the course of the podcast so far. Now, we are new to YouTube, and I don't want you guys to miss out on all the nuggets and all the knowledge that has already been shared. And we will have future episodes that touch on those topics again, but kind of like a chapter 2, and I don't want you to miss out on chapter 1. So here I'm presenting the Hello Adulting archive episodes. Now, the very first episode that I'm pulling out of the archive has to do with money management. Now, if you know me, you know that I'm all about people making their coins and people keeping their coins and people enjoying themselves with the fruits of their labor. So back when we just started Hello Adults in the podcast, I had a friend of mine on, and financial advisor Shamar Clarke. He came on and he shared a lot of information with us. Now, this is not the first episode. It's not the only episode with Shamar, rather this is just the first one that I'm sharing, and it's on 5 tips to manage your money. Now, these are 5 simple tips that you can implement in a very short time in a take note of you to sit down and learn them and apply them to your daily life. So here is the first episode out of our archives, 5 money management tips, presented by Shamar Clarke, who is a financial advisor at Sagicor.
Hello everyone, and welcome to another episode of Hello Adulting, the podcast. I'm Shanique. This week we're taking a crash course in financial management with special guest Shamar Clarke. Shamar is an entrepreneur and also a financial advisor at Sagicor, and he's sharing his expert advice on how to get and keep our finances on the right track. As always, get ready to take some notes and enjoy the episode. All right, Shamar, so you are I don't want to make any assumptions that you're good at money management, but you are a financial professional. So does that mean that you've always been good with your finances, like all through your life?
No, that doesn't mean I was always good with my finances. It means that I've learned to become good with my finances.
Mm-hmm.
I got into just as many problems as most persons do. Getting poor management with the credit cards, getting in debt with SLB, having outstanding loans, not managing my savings properly. So all the things that person have problems with now, not doing a proper budget, things like that. I've been there. Been there. Trust me, because in one earning that I have or had, let me put it that way. I stopped that business a little while ago. As a debt recovery personnel, which is a bailiff.
Mm-hmm.
I got that career because I was so bad in debt that the persons wanted to send me to court. And I said, here you go, and you have to give me the opportunity to work with you, and I'll pay you back then. And I became a debt recovery personnel, turned that into a business and earned from it, cleared out my debts and stuff. So when I hear people talk and say, yo, Mr. Clarke, you always am your thing good, I laugh about it because that's not true. That's not where I'm coming from. So
yeah,
I've learned to manage it properly, so that's why I'm so excited about teaching it and sharing it with persons, because I know that these are proven strategies that work.
Yeah. Well, I guess it's a good thing that we are talking to you because you've been on both sides of the coin. You've been on the side of not managing it properly to be now on the side of not only managing it properly, but also helping others to do the same thing. So let's talk first about then what do you think is the first thing to good money management?
The first thing, and I'm a champion for it, and everybody knows, the person that have heard me before, and it's called budgeting. You need to budget properly.
Mm-hmm.
You need to understand exactly what are your necessary expenses. When I say necessary expenses, I mean those expenses are required to keep you afloat or to keep you and your family afloat per month. The things that's your expenses without the wants. So some persons, well, you have a budget and you have the discipline to write down your expenses. But when you review your expenses, you realize that, I don't think this is so necessary. I don't think this is so necessary or whatnot. So you need to look at your budget to realize exactly what are the necessary expenses. Once you find this, you'd have now found the foundation towards your financial portfolio and how to grow from there.
Okay, so budgeting is the very first thing, and I agree with that. I've heard that a lot, and persons who would have listened to my previous episode would hear me say, I'm very good at writing down my budget every single month, but I'm not so good at sticking to it. So let's dig a little bit deeper into budgeting. Is there a specific budgeting technique that you recommend?
It's not necessarily a technique, because budgets are pretty easy. It's just, as you rightly say, the discipline. Because what a budget is really your income versus your expenses, and it is projected in the future. Most persons, though, they look at the budget like, all right, this is something that is going to hold me in prison. The budget is something that allows you to spend the money twice. So you spend it on paper, one, and then you spend it in reality. So that's why you're supposed to be sticking to your budget, because you do it as a projection forward, not a forensic thing to say, all right, January finish, let me look at my budget to see what I spent on. January start, and you're supposed to write down exactly what you're supposed to spend the money on, and then you stick to it and you consistently review. So that's one of the things that person don't do. That's why they always fall behind their budget, because they don't consistently look at it. You don't keep it a running order throughout your month or throughout the week.
Mm-hmm.
You just write it down one time, and then that's it for you. You have to stick at it. So a strategy is pretty simple. Put it on your phone if you can. Put it on an Excel sheet. Put it as a meeting on your weekend. So every Saturday you look at your budget and things like that. So that's one of the things that you can look at. There are structures when it comes down to budgeting. So you hear people talk about this, the 50-30-20 rule, or the 60-40 rule, and all these things. Your budget is going to be dependent now on if it's going to be wealth accumulation or debt management budget. Because some persons are so far gone in debt, your budget is almost like, all right, we're going to put aside a little bit for savings, a little bit for investments, but most of the money that has to go towards clearing off the debt. You have other persons that don't have a lot of debt, and because of that, now they can structure their budget towards wealth accumulation, which is mostly investments and stuff like that. So your budget is going to be dependent on your personal financial goals and where you are. So when it comes down to a hard and fast to say, save 20 here and 30 here and 40 here, that's not necessarily how I project or try to teach it. I want person to understand exactly what they want to achieve, and then the budget is geared towards helping them to do this.
Okay. All right. So they have the budget. There are different tools to help us to stick to the budget. There is a school of thought that you should put aside some income for a rainy day, whichever way you plan to do it. Some people recommend savings and some people recommend investment. Now, some people get scared when they hear the word investment, and I think that's for people who have a lot of money. But what would you say is the difference between a saving and an investment?
All right, so pretty easy. You mentioned a few things that I'm going to touch on it after I answer your question. The difference between saving and investing is this: saving is 1 + 1 + 1 + 1 + 1 + 1 + 1. It's your money growing, but it's growing very slowly. Because if you're just saving the money and you have it in the bank being saved, you're getting less than a percent on it, right? A percent on it. Now, if you're investing that same money, this money now even though it's going to be risked, investment is really your money being multiplied. So savings is adding, and investment is multiplication. So that's the major difference. Most of them is the same amount of money being put down. But if you save $100,000 per year, and that's all you do, you just save with the money. So it's very low interest, you're not getting anything on it, and you save for 10 years. That's $1 million, right? But if you would have invested your monies for the same $100,000 per year, even if you were investing in a low interest bearing instrument, so something that is giving you even 6%, you'd have had 6% 10 times over the years. So you'd have had a 60% growth on your money accumulatively over the 10-year period, right? So instead of you just getting back $1 million, you can get back $1.6 million. They're about a 1 million, even $1,060,000. That's a greater gain than you just getting back $1 million at the end of the 10-year period. So the difference is you is the money being multiplied in investment, or you want it to just be adding. But Shanique, let me tell you, there's So I answered the question. Now the part where I wanted to just touch on. Now there's a part of your portfolio that is required for you to have it in savings, and that's what you call the rainy day funds. It's like an emergency fund, right? So you're looking at about 6 months of your necessary expenses being put down. That you want to be in a savings account, a credit union, somewhere where you can grab pretty quickly in case of an emergency, right? So that's one part of the portfolio that you need to be looking at, and that should be there. But the vast majority of your money should be in an investment instrument.
Mm-hmm. So let's talk about investing from like the starting point. So you're a young adult, you don't really have all that money, but you do understand the importance of investing. What are some of the things that we should look into when trying to decide on what type of investment is good for you?
All right, two things really. You need to be looking at your time horizon, right? Why is it that you're investing? Is it that you want to invest to purchase a property in 6 months? You want to invest to buy a property in 5 years? You're investing because you just want to put down someone that you don't touch, right? And then now the other thing that you need to be looking at is what is my risk appetite, right? As I mentioned earlier, you have investment instruments that will protect your principal, so it's safe. So you're getting a lower interest on that. And then now you have investment instruments that are, say, equity based. So it is susceptible to changes in the market, so like stocks, unit trust, things like this, right? So you know how to figure out exactly, are you willing to risk some of your principal, or are you just interested in just getting some small gains? So once you can decide that, find out exactly what your risk appetite is, then investing is going to be pretty easy for you. And the notion that persons need to have a lot of money to invest is something that is for it was something that we thought, most of us thought years ago, but it's no longer that, because investment accounts can be created right now pretty easily and cheaply. For some even equity accounts $500, and investment unit trust accounts for $5,000. You don't need to have a million or 100, 2 or 3, $400,000 to invest anymore. You can start with whatever you have right now.
Mm-hmm. Okay, so based on what your risk appetite is, then that will kind of tell you what your options are, in a sense.
Correct.
All right, so we talk about accumulating wealth. And in one of the things, when you start out in life and you're going through, you're going to acquire some amount of debt. So whether it's your student loan debt, that's the first debt that you have, or you get a car, or you want to buy a house, like there are different debt that pop up as a young adult. What are your tips for acquiring and managing debt?
All right. So that's a great question. Tip for acquiring debt. Now, your debt that you want to acquire, especially in your young days, when you're just starting out, you want to be acquiring debt that is considered good debt. There is a big difference between good and bad debt, right? You want to acquire debt that is related to an asset. So you're 25, 26 years old. You've been earning you've been earning about $200,000 per month, and now you want to look into getting your own property. So that is some form of debt. That's a loan, but that's a debt that you're going to be taking on for an asset. Good. Now, when you're looking at getting a credit card is a debt instrument that's in your pocket. If you're going to be taking on that, it is useful. The credit card is useful. It's not necessarily bad. It's the management of it that makes it bad. So the credit card can give you opportunities, especially for persons that have a side business that they require to purchase things online and things like that, right? So just understanding exactly what are the days that you need to be paying your statements and these type of things. So that's not a bad debt to take on if you can manage it. Good. So when you're looking at student loan, no, you took out student loan like just like me. That was it. That was it. The company that I was telling you about that was sending me to court,
Mm-hmm.
SLB. So, and I'm grateful for them for that. Gave me an opportunity to think. But most of us take out SLB or student loan because we want to further our education, and we don't have that capital to go forward. They helped us. So that's a debt now that you want to clear off pretty quickly. Good. So when you leave school, when you finish and want to start working, you need to structure a certain amount in your budget to be able to pay this off comfortably over another 3, 4, 5 years, if so long. But rather than leave it to accumulate over time and compound on you and give you this big exorbitant figure for you to clear, right? Just once you start to service your debts as soon as you get them out. Try not to take out or run to take out a debt for a hike. Younger, you want a flashy car. Right? You can start out with something less expensive, but you're watching another person and you feel as though this is what I need to get. It's really not a need, it's more like a want, right? So ensure that you're taking out a vehicle when you're getting your vehicle, because most of us need to get around. Traveling is an essential part of our life now. Find something that is suitable for your budget and for your future plan, not just suitable for your image alone. So most of the debts that you should be acquiring in your younger days should be geared toward assets, not liabilities. And managing them, there are two ways to manage it, because Shanique, some person would have started and they didn't adhere to advice like these, or they just didn't know, because most of us don't know. And if you've gotten in debt already, there are two ways to really manage it. You either call it the snowball effect, where you pay the minimum fees on all debts that you have, and then the excess cash from your budget, now you spend that on the lowest one, right? And clear that off, and then you move the additional money to the other debt, and then so on and so forth.
Mm-hmm.
The other method now is when you have, say you have you have three debts, and one is 20% interest, one is 22, one is 26. You want to pay off the highest interest first. So you're looking at most times you're looking at paying on the credit card first. You clear that off, you get rid of the credit card, then you start on the second highest interest, and then you take it down from there, and then you do the same thing. So the same method is just that one is geared towards the balance of the debt, and one is geared at the interest rate. Well, those are the two major structures to manage your debt. But the view is that gear your debt acquisition towards good debts, which are asset bearing loans.
Okay. Sound advice. I know we're moving through a lot of things when it comes to money management. We're moving through a lot. So far we've talked about savings and investment. We've just spoken about debt. We've spoken about budgets. And one of the things I found to be kind of weird was I was talking to some persons after my last podcast, and they were saying, a retirement plan is like, so I was talking about pension, and I see the value in paying pension. And so, the company pays a bit, you pay a bit. And I said, you know what, I match, for myself personally, I match what the company is paying, because I see the value in it. So somebody sent a comment to me, and they were like, why would you be doing that? What if the company is doing this, and what if the company is doing that? Like, basically, they were saying they don't see the value in doing such a retirement plan. What would you say from your financial advice standpoint, the benefit of having a solid retirement plan, specifically a pension scheme?
All right, so you just touch on my passion right now, right? Because I have charities that I give to that person that are retired, and they're not getting anything in their pockets, right? And they're struggling. So I like to ask the question: is it that you want to retire as an elderly person or an old person? And people are like, what are you talking about? When you retire old, it means that you're dependent. Elderly means you're independent. There's a small difference. But all right, so looking at the retirement plan, looking at the pension specifically. Now, a pension has some benefits, and let's look at them. If you're over the tax threshold, so you're earning over $1.5 million, you're paying income tax. Good.
Yeah.
When you're paying a pension, the pension is tax deductible, right? So that means it comes out of your pay before any other thing comes out. That the pension is the first thing that comes out. So when your pension comes out of your pay, then income tax and everything comes out. If you're paying more to your pension, then you're paying less to income tax, because there's less income for it to tax.
I did not even know that.
Yeah, so that's one of the major benefits. So for me, I don't want to disclose my salary. So once you over say $6 million per year, trust me, the income tax big, and you don't want to look at it per month, right? So and I can tell you, for anybody that is listening, once you increase your pension, the pension is your maximum you can contribute to the 20%.
Right.
So the company, some companies match the 10 up to 10%, and you can contribute up to 10, which brings you up to 20. Some companies go to 5, and you have up to 15 to contribute. It depends, but by law under the Pension Act, your contribution is limited to 20%. Now, some persons are of the thought, and like what you mentioned earlier, that boy, I know what the company are doing this and that. The company is not usually the ones that are managing the pension fund, right? There are very rare cases where the company has the person managing the pension fund. They're usually managed by a financial institution, say a Sagicor, a Guardian, a JMB, a Proven, these companies. Good. So Sagicor now being the largest pension fund in Jamaica now. So most of the companies, say even where you say a Digicel or Rare, these companies, their pensions are being managed by Sagicor. So the trustees within the company now have their meetings and whatnot, and they decide exactly what type of risk appetite they want for the company, and they negotiate with Sagicor and whatnot, right? For them to manage your funds. Your pension fund, the other benefit is that it grows on compound. So you are putting now money that is growing on compound consistently over 30, 40 years, consistently. And this is growing without tax. So your money is not taxed while it is being invested. So you're talking about tax-free money that is being compounded over the years. It is very difficult to compete with what you're going to be getting from your pension fund because of the compounding effect. Do you remember how compound interest works, Shani?
Not an idea.
Not an idea.
Nope.
All right, so the difference between compound interest and simple interest. So simple interest now, think about you having, let's work with $100,000. $100,000, and then you put 10% on the $100,000, that's 10 grand. Right. And then 10 grand brings you up to 110,000, right? So if your interest rate is 10% per year on a particular instrument, next year the principal was already 100,000, so you're getting another 10% on the 100,000, right? For that year. So each year you're getting a 10,000 on your money. That's simple interest. No compound interest. Now think about it this way. You have $100,000 and you're getting 10% per year compound. You see, when you get the first 10% for that particular year, now you have $110,000. Now $110,000 is now your new principal starting year 2. So after year 2, now your interest is going to be your 10% interest on $110,000 is $11,000, right? And then the $11,000 now grows on the $110,000 as the new principal. So the interest continues to grow on the principal, so the base gets bigger and bigger and bigger. So that is the difference between compound interest and simple interest.
Okay.
So what happens is that down the line, your money become big and wagga as like to say. You understand? And you see a great turnaround. So it's very difficult for you to compete or beat compound interest when it comes down to your pension. And that's one of the best vehicles because the money is growing without any form of taxes. So having a pension fund or a pension plan, it is very important. It's vital when it comes down to your financial security, especially when you reach retirement. Especially because it's only 20% of the population of a pension. Most persons usually shy away from it and they want to invest the money themselves, but you don't have a discipline to maintain. How disciplined do you think you'd be, or most persons are, to put down some money consistently for 40 years?
Me specifically, not that disciplined. Yeah. As I'd say, I find it hard to stick to my budget every month. So I know that things like that I would have to do.
So that's one of the major benefits of a pension too. So the money is growing and you're definitely not touching it. So you just know that that's money that you're going to get when you retire, if and when you retire. You understand? Because if you have that money, control over that money, which person say, we can do better with money, but yeah, you can do better with the money this year or next year. But what happens when you want to purchase a property the year after? You take out all of the money and you consistently invest all of your money and you dump all your money in high risk instruments. And when you get to retirement, there's nothing for you to have. And then you sit down and you regret. My career has put me in front of so many persons, and I like to ask persons that are in retirement, what are their regrets? And a lot of their regrets are that they didn't listen, or they didn't start a pension fund earlier. Them starting about them pension in them 40s, 50s, them should have started invest earlier. And the information is out there. We're in an age now where the information is readily available. You cannot type in a Google and see, right? The best advice is always to start your pension earlier, because it means now that you're able to get better returns because of the compounding effect down the line. Yeah. So my advice is really to invest in your pension fund. If you don't have one through your company, you can start one individually. You don't need to depend on your company. You can start one individually. So it's important for you to get. I told you it was my passion, so I can talk about this all session. Right? If you started your pension late, then you can use other investment instruments now to compound or to supplement your pension, right? Like life insurance. A life insurance plan can help you to do that because the premiums that you're paying are invested and the interest grows on it and the cash value builds up over time. So you can use that as a supplement to your retirement plan. And most persons don't even know that much.
Right. Yeah. There is definitely a lot to know and a lot to learn. And I think one of the best things I did for myself when I started out on my adulting, when I doing things on my own, was to get a financial advisor. but when you have somebody in your corner that can help you to do those things, I think that's definitely where the benefit is. But to wrap up, what would be your top 3 things that you want people, listeners, to take away about money management?
Top three things. Top three things. Well, one is always going to be budgeting, right? So I'm gonna implore a person to take advantage of getting in the habit of actually doing proper budgeting. It's important that you do so. You can change your entire future. You can change the future of your future generations by spending a few minutes per month just to look at your own budget, right? Understand exactly what it is, find out what kind of budget you have, and put it in place ASAP. If you don't have one, you need to put one in place. That's the first rung on your financial ladder. There's a reason why companies pay persons so much money to manage your account and manage your budgets. Yes, it's because it's that important to the sustainability of a particular institution. So why do we want to not manage our own monies properly? So get a budget in place. We mentioned emergency funds initially when you were talking about your rainy day funds.
Yeah,
That's important for you to have. If you're only focused on investing and not saving some money just in case of emergencies, when emergencies come, what's going to happen? You're going to want to go to all your investments to pull the money from those, or you're going to want to take out a loan, right? So we need to prepare for that. So an emergency fund is important for you to get. Maybe I'll come back and educate you as to how to fund one, but an emergency fund is important for you to do. The other point that we mentioned, that's also important, because there are several when it comes out of finance, but I'm just wrapping up based on our points we discussed. The pension. It is a sore point when persons get to retirement and you're not able to live the life that you want, and then you have a lot of regret at that point in time in your life, knowing that you could have just simply done it, and it is not going to be taken away from your livelihood, right? So you're listening to persons that are not educated when it comes down to finances, that don't have experience when it comes down to proper management of finances, right? And not doing the right things. So you mentioned it earlier, get a financial advisor, right? Somebody that is educated in the field and understand exactly what they're doing. It's not important. It's not. You don't have to be making a lot of money for you to get an advisor. Somebody just to say, here I go and do a little thing like this. There are just some simple proven techniques. Getting wealth is not as difficult as I thought it was when I was younger. Very easy, actually. It's really just managing your money properly, right? Putting it where it's supposed to go. And that's why the budget is so important and so integral. So top 3, budget is important. So look at it and ensure that you get one in place. Put in force an emergency fund, because whatever can go wrong usually does, right? Ensure you get a pension plan in force. Ensure they get a pension plan in force. And you need to look into risk assessment tools as well. So risk assignment tools, ensure that your risk is properly assigned. Don't assume the risk, because if you do assume the risk when it comes down to your financial portfolio, your investments are at risk. Right? So those are some of the 3 of the tips that I can lend within our short space of time.
Thanks so much, Shamar. Let's say persons want to hear more. They hear the 3 tips and they do want to hear some more. Tell us how we can get in touch with you, how we can, take advantage of your services, all of that.
I'm pretty easy to get through to. My contact number is 325-6944. You can find me on Instagram. I started utilizing that platform a little more recently. It is Shamar Clarke. So I'm Shamar Clarke. That's my Instagram handle. Find me on Facebook, Shamar Clarke. My website is shamarclarke.com. So you type in my name, and if you just type my name in Google, you should be able to find me. Shamar Clarke, Financial Advisor Jamaica. I'm pretty easy to find, and I'm around.
Perfect. Thanks so much, Shamar. Appreciate the time and appreciate all the advice.
You're most welcome, Shanique.
Now, of course, if you want to listen to additional episodes of Hello Adulting, the podcast from way back when, and continue to learn and catch up on your own time, you can find us wherever podcasts are available. I will link our Anchor platform down below, so you can find all of our old episodes. And of course, we will still be bringing episodes over here. So if you want to wait on the rest of the archive series, you can do that as well.